alongside as far as markets are concerned. Anirudh Garg joins us, partner and fund manager at INVasset PMS. Namaste Anirudhji, and a very warm welcome to you, sir.
Good
For the
afternoon,
Nifty,
Mr.
it
Bhatnagar.
seems that 22, good afternoon, sir. For the Nifty, it seems that 22,800, 22,900 seems to be, at least for the moment, a support level that the market seems to be actively looking at. What is your impression of sentiment on the Lal Street? Where do you think we are headed in February at least?
Yeah, so I think this is a time of extreme fear that is going on in the market. We see that for pattern something like what happened in June of 2022. I think it's a very, very good time to buy. Mr. Bhatnagar, we have been as a PMS on cash for the last 3 months. I think one of the only PMSs in India to do that. So we are jumping all in. I think by the end of the day today, we must have employed 98%, 95 to 98% of our capital back in. So for me, the valuations are attractive. I am afraid of only two things in the market. One is the valuations and the other thing is exuberance. I think both of them have faded away, giving us a good opportunity to enter the markets and the stocks that we like. The portfolio that we are buying today is around 30% down from the peak. So yes, a good sale going on in the market. We are very happy to, avail it for our clients.
Okay. Anirudhji, in terms of investing at current levels, where do you think lies value? What are you purchasing, which is down 30% at least from its most recent attractive price? And if you can just share some names, then probably we'll drill it further.
Okay, so I think I'll share the broad sectors and you'll understand that we are not allowed to share names when the buying is going on, especially Mr. Bhatnagar. So sorry for that. But see, results came out for a capital goods company,
Yes.
which is one of the best companies in India. Yeah. So the results were fabulous. The stock is down 30-40% from highs. So this is how value emerges in the market. And we are buying such companies. Apart from that, a few more companies, something in the EMS space, something in retail. We are also buying companies in pharmaceuticals, which is the biggest proportion of our portfolio. Around 25% we are having pharmaceutical, especially CMOs and CDMOs. And apart from that, we also like something in real estate. So all these companies, the leaders, the good companies where the balance sheets are strong, where the entrepreneurs know what they're doing, where there isn't a fundamental problem, where the growth is intact, at least for the next 2 years, we are buying those companies now.
Okay. Are you focused on the domestic theme in India, or are you looking at some global exposure, maybe metals as well, where you've seen a very sharp erosion in prices? What is the general value sheet that you are looking at?
Yeah, okay. So we operate on a relative change criteria. That means that the advantage that a company has today that it did not have earlier. So where are we seeing this relative change happening? First of all, it was the budget. Okay, it has put 1 lakh crores in the hands of Indian consumer. Now you have to analyze what ways it can go and what are the companies that will be able to capitalize on this opportunity. Secondly, what is happening in US is a very positive change for me. I think Donald Trump has wakened people out of their slumber. Sometimes it takes a little bit of shock to get you out, and then the ones which are good, ones which have their business, which have their things properly sorted out, will excel. So a lot of companies with US exposure, which are leaders in what they're doing, should do pretty well in the coming future. Apart from that, I believe some domestic companies themselves are very, very strong. Some big brands like something in retail, something in airlines, something in delivery. These companies are doing pretty well and should continue to do so in the future as well. You're getting them at better valuations. Of course, there are capital goods companies. The Indian capex has taken a hit because of government policies. But now again, the last 2 years, everything was going up. Now only the good ones should excel. And the valuations overall have corrected, and I think they're mouth-watering right now.
Okay, fair point. What is the size of your PMS?
So we are handling a total of around 800 crores, which includes around 400 crores, 450 crores of
Okay.
client money and around the same amount of prop money.
Okay. And when you go out on hunting, are these large cap stocks that you're buying, or is it a mixture of large, mid, and small? What exactly
I think,
is the broader theme that you are aggressively addressing by buying?
okay, so I think around 45% is large caps because some large caps are available at extremely good valuations. Then around 35% would be mid caps and around 20% would be small caps.
Sorry, I couldn't catch that. About how
45,
much?
45 would be large caps, 45% large caps,
Okay.
35% mid caps, and 20% small caps.
Okay. Okay. And is this the deployment of cash that you had collected over a period of time, or is this fresh money also being injected? For instance, you
Yes.
said that in the last 2 or 3 days, or maybe today, your buying would be over. So this is cash that was lying, or is it also some fresh capital coming in?
So back in September of 2024, I think we moved to 100% cash for our portfolios because there was too much froth in terms of valuations and exuberance in the market. This is something that we do from time to time. Did this in September of 2021. We do this approximately at the end of a cycle. Uh, so we are deploying this cash. And yes, our investors, we've been, when a fund manager sells, it's very difficult to convince your investors because that time the psychology of the investor is that a lot of money is being made out of the markets. We, that time, take a call, educate them, tell them that we are all investors and not stock market investors alone. When we have made money in the last couple of years, it's okay to take a breather, step down, step in alternate assets, go into cash, and then ultimately when things would be right, stock markets is all cycles. We are not at all believers of that Warren Buffett type investing where we marry a stock for 20 years. We believe that we are buying stocks for a 3 to 4 year period, and we are just riding the growth curve wherever growth is. And whenever we feel that the exuberance and the valuations are not in sync with historical valuations, we are okay to step back. So we are deploying that cash, as you asked, Mr. Bhatnagar, and a lot of our clients are topping up because we have proved it right for them. So they have more confidence. They are topping up now, and that cash is also being deployed. Yes. So I think a good way of investing is being done now.
Okay. When you talk about riding the growth theme, what is it that you are actually looking at? Expansion of PE, or maybe a consistent quarterly performance over the last 4 or 5 quarters, maybe a rise in market share. What is the broader valuation matrix that you addressed with your buying?
I think all of the ones that you said, these are all a part of our analysis. First of all, the best companies that we like is the ones that no one is talking about, because we believe that every bull run will be led by new leaders, be it a stock, a sector, or a group. So we try to identify new sectors. For example, let's not go very far in history. Let's talk to post-COVID. Post-COVID, firstly, the run was led by COVID was a medical problem, had to be, had tackled medically. So it was a time for pharmaceuticals. Since we were in a lockdown, it was a time for IT. Then came government went into the biggest ever capex plan. So it was a time for the capex oriented sectors. Now the relative changes, as I told you, we are seeing in the budget. There's a lot of consumption theme that is going to play out. A lot of China plus one theme that is going to play out. And then again, those strong sectors where the earnings, they are just gaining market share. They are just, doing away with the old way of doing business and getting a new way of doing business in hand. Something, say for example, something like a Trent. Yeah, it's changing the way business is being done. Smaller cities, from where I originally belong, Ludhiana, Trent has opened up 5 stores in a matter of 1 year, and whenever you go, the stores are full. So these companies are
Yes.
changing the way the business is being done. So yeah, we look like companies like these.
Okay, but this is all in hindsight. This is all done and dusted.
Yeah.
What are the sectors which sort of match the current profile of a rising top line, rising profitability, rising profit, winning market share? We are at the moment in a contracting economy.
Mhm. See, I do not believe that we are in a contracting economy. I think these are phases. We are in a contracting phase of an economy. These phases come from time to time, and that is what you have to, predict as an investor. That will your companies be able to outpace the contracting economy phase? Okay, I may own disclaimer. I may own and not own something like a Zomato, but the way Zomato, the way Blinkit is being used today, I don't think a contracting economy is having a lot of pressure on this on the sales of this company. Though there is competition generally, but overall, some companies are changing the way business is being done. In the contracting economy also, we were in a phase of lockdown back in 2020. That could have been the maximum time our economy could have been contracted. But at the same time, we saw the biggest bull run. So generally, markets are forward looking and they are discounting what is going to happen after 2 years. Okay, so the markets will not tell you what is happening today. They will tell you what will happen after 2 years. So there will be a lot of companies where opportunities are, and I think whatever we had to talk about risk and all had to be talked when there was so much exuberance in the market. Now, since there is too much fear and the valuations are very, very supportive, it's actually a time to talk the other way.
Fair point. And markets are composed of buyers and sellers and opposing views. Unless I sell, you can't buy. And unless you sell, I can't buy. We have to have an opposing thread in terms of how views make up. It's a fairly well accepted practice. Also, the fact that the internet companies, some of them got listed in the last 3.5 years again, fall directly into the space that you're talking about, rising sales, rising acceptance, rising market share, and of course, a bit of froth has also been taken away. How do you see the PSU basket? Here also, you have PSU banks coming up with a very serious set of aggressive numbers. Stocks have corrected substantially, and of course, you have a scenario where bank rates have also come down. So, is that a hunting ground for INVasset?
Absolutely. I really love PSU banks right now. See, I'll explain it to you why. When you buy PSU banks are major lenders to corporates. Now, what happens is that over a period of time, when the corporate balance sheets are not doing good, they especially say, suppose let's talk about metals first. When the global growth is not there, you will see a dip, the metal prices and all not rising. These are all customers, major customers for PSU banks. Now, as you start seeing green shoots coming back, the PSU banks at these valuations will be the prime most beneficiaries of it. Now, at current level, we like PSU banks. We are not owning any. We are just, some trying to make a sense of how the global growth will plan out. If the global growth plan out well, I think PSU banks among financials should be the biggest bet for the next couple of years, apart from consumer finance, which again, because you've put in 1 lakh crore into the economy in the hands of the consumer. Apart from that, when we talk about PSUs, Mr. Bhatnagar, we have to see to the fact that here the valuations are okay now with a lot of capex oriented sectors like railways, defense, um, maybe power, infrastructure. The valuations are now getting okay, but the opportunity, the relative change is not there. So just valuations also, according to us, won't work. You have to look at the what the relative change is for the next 2 months. The relative change for capex is negative. Now, since government is going into the freebie type of economy, it has to be taken away from capex, and the incremental order share, the buoyancy that the market was expecting out of this is all being taken away. So these sectors we had made maximum money in the last bull run out of these sectors, but now we aren't owning any. So it has to be a combination of both. The valuation should be right, but for the next 2 years, the visibility should be strong.
Fair point. Let's look at the other space, which is the financialization of assets. Again, they fall in your hunting ground, rising market, of course, wider acceptance of equities as an asset class going ahead, and a huge addressable market. Is there in your buy list some of these companies where you see massive price correction? It could be, automated back-end providers to the wealth management space. It could be exchanges. It could be brokers. What looks good?
The second biggest relative change and the second biggest sector exposure or second biggest theme exposure that we have is the financialization of asset space. I think this is something which is a reality and a decadal theme. It happens, to get everybody together to go one way is very, very difficult for a sector. And I think this is a truth now that the Indian consumer, I say it in my office in a very different way, that it's time to take back from the corporates. So the financialization of assets is the truth. And this sector has not been considered, it's always considered as a cyclical sector going back. I think it's time that it comes into the quality sector part of the analysis of research teams and the research advisors. Now, I believe all these sectors, be it exchanges, be it depositories, be it good brokers with good networks, all of them should have significant increase in their top lines and bottom lines, and a lot of re-rating as well from the way that they were perceived to be in the past.
Okay, fair point. But what attracts you in this theme? Either the back-end service providers or maybe brokers or exchanges? What is the most attractive part in terms of valuations? All these stocks have created corrected at least 30-40% from their most recent peaks.
I think we are buying all of them. Overall, I think it's a overall bull. It should be an overall bull run and overall opportunity for this sector for the next few years in India. At least for the next 4-5 years, and we are buying the best in that, the most integrated and the most, I would say, well managed ones. So we have bought exchanges, we have bought depositories, we have bought brokers. We are buying back end, we are buying everything in this sector. We really like this theme. And especially, when you have worked 20 years, 25 years in this particular sector, when it starts to explode, when there is an opportunity, you as an investor or a broker, you tend to know it first. So you can understand the gravity of it. So we are very bullish on this.
Okay, fair point. So this is a happy hunting ground for you. How about NBFCs? We've seen banks getting a liquidity injection both in terms of OMO as also a cut in the CRR. Is this a space which falls in the matrix that you are looking at in terms of market expansion at least?
Just the very quality ones. Because the way the NBFCs are lending these days, we are not very happy with it. So we are very, very sure that we will either like public sector banks in this run, or we will like NBFCs, which are very, very quality ones. Especially the one which is the biggest in the consumer space.
Okay, we are talking about Bajaj Finance here. Okay, so it's a very selective market for you there. Fine.
Yes, absolutely.
And what are the spaces that you are avoiding completely? जहाँ पर कुछ नहीं करना, where no matter what the price is, you don't want to enter because the froth remains, and of course maybe valuations are still expensive, maybe the prices haven't corrected as much, or maybe there is more pain left. What are you not touching with a barge pole even?
Okay, so we are not. So see, from here where we are, there should be a there's a lot of valuation correction that has happened. So sentimentally, there should be a good run from here in everything. But what we don't want to own for 2 years, that we are not touching. So I don't want to own autos for the next 2 years because I believe it's a very, very capex oriented and very competitive industry going forward. I don't want to invest in capex for the next couple of years, especially the ones which are totally dependent on government. And uh, I I think these two sectors particularly. Real estate also I'll be very choosy.
Okay, so you're not buying hotels and you're not buying. Okay, and you're not buying anything which is linked to the government in terms of government orders. Fair point.
I said
that
autos,
sort of
not hotels. Autos.
keeps you away from 40% of the market.
Sir, I said autos.
Okay, my apologies. Okay, fine. Autos is not your cup of tea. Fair point. And autos, of course, is going through a heavy flux as well, given the impending change that we are seeing towards EV and away from petrol-driven engine sets. How about chemicals, Anirudh? This is a space where prices have corrected substantially, but of course it remains hostage to what the Chinese are capable of. Is there a space that you are buying in the chemical sector?
I think, Mr. Bhatnagar, chemicals have been in a bull run since 2013. And this bull run has been one of the longest that has been there in the Indian bull markets. So now a lot of facilities have been set up. So when we buy chemicals, we'll be very, very selective. You need your research guys to be very, very selective, knowing each and every component, knowing what chemical exactly to buy, which is in shortage. Otherwise, this industry, as you rightly said, the China factor is there. I would say now the India factor is also there. You have to be very selective when you're buying chemical companies for us.
Okay, a fair point. Let's keep that in mind as well when we discuss chemicals upfront. And pharmaceuticals, they have been, along with IT, the mainstay of the market since we started correcting heavily from September onwards. They've put a brake on heavy selling pressure and within themselves created a certain amount of value. Is this something that attracts INVasset?
Yes, absolutely. If not for the entire couple of years of bull run that starts from here, I think for the next 1 year at least, we're in a mid-cycle in pharma. And I think in this mid-cycle, one of the best bets that we can have is pharmaceuticals. So something in pharmaceuticals we like a lot because we are very, very sure that post-COVID, you cannot just have one power center in something as delicate and as important as pharmaceuticals. India, especially due to government policies in the last 3 decades, we have a very extremely nice center and hub for pharmaceuticals that we have made here in India. Something which is very, very difficult for other industries to do. And when it comes to delicate products like pharmaceuticals, which have health importance and something you cannot go to newer players, you cannot go to newer economies. It is countries like India and China which will be always at the helm of producing these things. And post-COVID, we all know that you cannot rely on one country. India has to come here, and the share of these countries as share of India as a globe in terms of global pharmaceutical industries in the next couple of years should rise significantly.
Okay, fair point. And in this struggle for power, as you can see, summers have come in early, at least in North India. I'm really wondering why I'm wearing this half-sleeved sweater. It's only February and we seem to be getting our ACs serviced earlier. So power will be an interesting theme to look at over the next 1 month or so. Anything that catches your fancy in terms of valuations that may have corrected in the likes of NTPC, maybe Tata Power, JSW Energy, anything that looks good here?
So we have a policy that, something that has run up significantly and the valuations have become out of sync to a factor that they were the leaders of the last bull run. We look for opportunities elsewhere. If I have to, since you rightly said, and I know that the
Okay.
winters have been not that great this time, and the summers have come up early. So I would rather look at an air conditioning company rather than a power company.
Hmm. Fair point. And they also sort of fall in sync with this additional tax benefit that seems to be headed towards the middle class to the tune of about 1 lakh crores. Let's hope the likes of Blue
Absolutely.
Star and Voltas do something out of the ordinary. Blue Star is already at a record high. So users might want to look at that particular stock. 325, Anirudh. This has been a very, very interesting conversation so far. I just wanted to understand one more thing as far as INVasset PMS is concerned. What is your typical holding period, and do you also hedge your portfolios?
Okay. So, Mr. Bhattnagar, we divide our cycle into four parts: value, growth, quality, and safety. The first is value. Value, we buy value only when there is overall value in the market. Because we feel that what may seem as value in a bull run can actually be a value trap. The holding of value, which is stage one, which we are doing currently, is around 6 months. Then comes the growth phase. The growth phase is where we believe that every bull run will have a new leader due to some relative change, an advantage that a stock sector or company has today that it did have earlier. This is the largest holding period, where the holding period is generally around 12 to 18 months. Then as the markets they become expensive, we go into quality. Quality are those Warren Buffett companies which you can be okay holding in a bear period as well. Stage three, the holding period is somewhere. If you enter into a bear run, you have to be into the bear run with them, as was a time with COVID. So the holding period can matter. Generally between 6 months to the maximum that we have held is 24 months. And fourth is the safety. Safety here we either buy gold or we hedge our bets or we move into cash like we did. Now it depends. If we are doing it in a bull market, continuing bull market, it can vary between 3 months to 6 months. But if 3 months to 1 year, sorry. But if we do it in a bear market, it can vary between the time period can be extended to say 2 years. So this is our typical holding period, but our portfolio overall in a period of 3 years is changed around 4 times.
Yes, that would be because you chase growth, and
Yeah,
the fact that growth lasts for maybe 6, 8, 10 quarters, and then you switch. That's fairly
absolutely.
understandable. Thank you, Anirudh, for this wonderful conversation. I hope you enjoyed it as much as I did, and I'm sure viewers will come up more intelligent than what they were 30, 35 minutes ago before this conversation started. Thank you so much
Thank you,
for your
Mr.
time.
Bhatnagar. Thank you so much.
This was Anirudh Garg, fund